Hello viewers, welcome to my channel. I am Hashim Ali Khan here. Now I am going to start the main problems on depreciation. The last two videos, first video I have given the complete introduction to depreciation. The next video I have given all the short questions on depreciation. So if you have watched those two videos, then definitely you got a good comment on this topic of depreciation. So now I'm going to start the main problems on depreciation. So before starting the problem, I expect that my viewers are having the printout of the problems which I have given in the link under my description. So go to the description, last line you will find the link, click the link, get the copy, make a copy, then keep it ready before watching the video. If you are first time watching my channel, I suggest you to go to the playlist of my channel. I have uploaded a number of videos on different subjects. Select your subject, watch the video. Definitely you will gain a lot of knowledge from these videos. Now first main problem I am going to read out. See the first problem. On July 1st, 2009, Granites Limited purchased second-hand machine for 40,000 and reconditioned the same by spending 6,000 rupees. So this company has purchased a second-hand machine. So second-hand machine, the cost of the machine is 40,000 and to recondition it has incurred 6,000 rupees. Now the machine cost will be 46,000. So all the incidental expenses in reconditioning, installation, that will be added to cost. The depreciation will be provided on 46,000. On 1st January 2010, a new machine was purchased for 24,000. See here, second machine. The first machine was purchased on 1st July 2009. The second machine was purchased on 1st January 2010. That means immediately after 6 months. After 6 months, 1st July 2009, first machine, second machine, 1st January 2010. The cost of the second machine is 24,000. On June 30th, 2011, the machine purchased on January 1st, 2010 was sold for 16,000. तो second machine जो purchase किए थे 1st January 2010 24,000, that second machine was sold on 30th June 2011 and it is sold for 16,000 rupees. And another machine was installed at a cost of 30,000. On the same date, 30th June 2011, one more machine was purchased. One more machine was purchased for rupees 30,000. The company writes off 10% on original cost every year. That means straight line method. It is given depreciation will be provided at 10% on original cost. Means straight line method. Every year on 31st March, accounts are closed on 31st March. Show the machinery account up to 31st March 2012. So we have to make the machinery account up to 31st March 2012. When the first machine was purchased, 1st July 2009. Now see carefully. Main problems on depreciation, machinery account. So ledger account I have prepared. Debit side 4 columns, date, particulars, JF, amount. Credit side 4 columns, date, particulars, JF, amount. First of all, when machine is purchased, the entry is machine account data to bank. Machine account data to bank. Machinery account should be debited. So debit side, July 1st, 2009 to bank cost. The cost of the machine was 40,000. And again to bank, reconditioning. How much reconditioning expenditure? 6,000. So the machine cost is 46,000. We have to provide depreciation of 46,000. This is the cost of the machine. Now, in the same year, because accounts are closed on 31st March, every year 31st March, we have purchased the first machine on July 1st, 2009. Year ends on 31st March 2010. Year ends on 31st March 2010. But before 31st March 2010, on 1st January 2010, the second machine is purchased. So to bank, cost. What is the cost of the second machine? 24,000. First machine was purchased on 1st July 2009. The second machine was purchased on 1st January 2010. Same year. Because every year accounts are closed on 31st March. The first year ends on 31st March 2010. So before 31st March 2010, on 1st January 2010, we have purchased the second machine. Now we are having two machines in the same year, right? Now year ends 31st March 2010, we are closing the accounts, depreciation. Now we have to provide depreciation on both the machine, first machine and second machine. The first machine 46,000. So 10% of 46,000, 4,600 is the annual depreciation. When the machine was purchased? July 1st. When we are closing the accounts? March 31st. So how many months? July, August, September, October, November, December, January, February, March. 9 months depreciation. We have to provide 9 months depreciation on first machine. So 10% of 46,000 into 9 by 12. You will get 3,450. So 3,450 is the depreciation on the first machine. Second machine 24,000. So 10% of 24,000 into 3 by 12. Why 3 by 12? It is purchased on January 1st. And we are closing the accounts on 31st March. So January, February, March. Only 3 months. So 3 by 12. So 10% of 24,000, 3 by 12, 600. Take the total. 3,450 plus 600, 4,050 is the total depreciation on both the machines. Now we take the total. Debit side total 70,000. 40 plus 6 plus 24. 70,000. Take 70,000 credit side also. Now from 70,000 subtract 4070. The balancing figure by balance carried down. Balancing figure 65,950. This is the closing balance of first year. It will become opening balance for the second year. Now second year will begin from 1st April 2010. 1st April 2010. To balance brought down 65,950. Now next year ends on 31st March 2011. In between, from 1st April 2010 to 31st March 2011, there are no purchase, no sale, nothing. No other machine is purchased, no machine is sold. So we close the year by depreciation. Now depreciation is provided on original cost method, straight line method. So annual depreciation will remain same, 10%. So 10% of 46,000, 40,000 plus 6,000. 10% of 46,000, 4,600. 10% of 24,000, 2,400. So 4,600 plus 2,400, 7,000 is the depreciation on both these machines. First machine and second machine. Now take the total. 65,950 minus 7,000, 58,950. So 58,950 is the closing balance of machinery at the end of second year. Now we come to the third year. Now the year begins from 1st April 2011. Here the year ends on 31st March 2011. The next day is 1st April 2011. To balance brought down 58,950. 58,950. Now year started on 1st April 2011. So year ends on 31st March 2012. But in between, on 30th June 2011, the machine which is purchased on 1st January was sold away. So whenever a machine is sold, 3 entries we have to pass. The first entry is sale proceed. The second entry depreciation. Third entry profit or loss, whatever it may be. So here the machine is sold on 30th June 2011. Year begins from 1st April 2011 and April, May, June, 3 months. Only 3 months. April 1st the year started. Then April, May, June. 30th June the machine is sold. So when machine is sold, 3 entries. The first entry, bank account debtor to machinery account. Bank account debtor to machinery account. So by bank, sale 16,000. 16,000 rupees. At 16,000 the machine is sold, given in the problem. Right? Second entry, depreciation. Depreciation on that machine which is sold. Which machine is sold? The machine which is purchased on 1st January 2010. What is the cost of the machine? 2,400, 24,000. 24,000 is the cost of the machine. Depreciation at the rate of 10%. So 10% of 24,000, 2,400. So annual depreciation 2,400. Here the machine is used only for 3 months. April, May, June, only 3 months. So 2400 into 3 by 12. 2400 into 3 by 12. 600 rupees is the depreciation. 3 months depreciation, 600 rupees. So 2 entries we have passed. The first entry, sale proceed by bank. Second entry, by depreciation, 600. Now profit or loss on sale of machine. That we have to find. That is the main complicated thing. So actually the machine was purchased on 1st January 2010. At what price it was purchased? 24,000. Now year ends. Year ends on 31st March 2010. Purchased on 1st January 2010. Depreciation up to 31st March 2010. 3 months. January, February, March. So 24,000 into 10% into 3 by 12, 600. So first year depreciation 600 already we have calculated here. So minus 24,000 minus 600, 23,400. Less depreciation up to 31st March 2011. 1 year depreciation. So 1 year depreciation 2,400. 10% of 24,000. Original cost method. Original cost is 24,000. So 10% of 24,000, 2,400. Subtract 23,400 minus 2,400. 21,000 is the WDV on 1st April 2011. 1st April 2011 WDV is 21,000. Now it is sold on 30th June 2011. 30th June. So depreciation up to 30th June 2011. 3 months. April, May, June. So 10% of 24,000 into 3 by 12. 600 rupees depreciation for the current year. Here already we have taken 600 rupees. So current year, date of sale, year of sale, 600 rupees depreciation. Minus 21,000 minus 600, 20,400. This is the WDV of the asset on the date of sale. On the date of sale, 30th June 2011, the written down value of the machine is 20,400. And the sale proceed is 16,000. Sold for 16,000. Actually the value of the machine is 20,400. So it is a loss because 20,400 worth of machine was sold for 16,000. Sale proceeds are less. So loss on sale of machine is 20,400 minus 16,000. 4,400 rupees is the loss on sale. So what is the entry for loss on sale? Here I have written profit and loss account data to machinery account. Profit and loss account data to machinery account. So machinery account is credited by profit and loss account. So here I have taken by profit and loss account 4,400. Just now we have calculated here. That's it. So these are the 3 entries we have to pass at the time of sale of machine. Over. Now we close the year. On the same date, on 30th June 2011, one more machine was purchased, 30,000. So June 30th, debit side to bank cost. What is the new machine purchased? 30,000. Now we have to close the year 31st March 2012. We have started the year on 1st April 2011. Year ends on 31st March 2012 by depreciation. Now we have to provide depreciation on 2 machines. First machine and third machine. Second machine already sold out. So first machine, what is the depreciation? 4,600. 46,000 into 10%, 4,600. First machine. Third machine just now purchased, 30,000. When it was purchased? June 30th, 2011. And when we are closing the accounts? 31st March 2012. So how many months? From June 30th, 2011 to 31st March 2012. 9 months. So 9 months depreciation we have to provide. So 10% of 30,000 into 9 by 12. It comes to 2,250. So 4,600 plus 2,250, 6,850. Total depreciation 6,850. That's all. Now we'll take the balancing figure. Debit side you take 58,950 plus 30,000, 88,950. So 88,950 minus 16,000 minus 600 minus 4,400 minus 6,850. The balancing figure is 61,100. 61,100 is the balance value of the asset. This is carried over to the next year. 2012 April 1st, 61,100. It is asking you to prepare the machinery account up to 31st March 2012. So here 31st March 2012, this is the value of the machine. That's it. This is the first problem on depreciation. So the main complication is regarding the calculation of profit or loss on sale of machine. So in the first attempt itself, you may not be able to understand. Rewind the video, again you watch it, definitely you can be able to understand much better. Now we'll start the second problem, second main problem. Already for one problem we have completed. Second problem, see carefully. Rajesh purchased a second-hand machine for rupees 18,000 on 1st April 2010. He spent 2,000 on its overhaul and installation. The date of purchase 1st April 2010. The cost of the machine 18,000. It is a second-hand machine, so some expenditure is incurred on overhauling installation. So 2,000 rupees will be added to 18,000. So 18,000 plus 2,000, 20,000 is the cost of the machine. On 20,000 we provide depreciation. Depreciation is written off at 10% per annum on original cost method, straight line method. On 30th June 2013, the machine was found to be unsuitable and sold for rupees 4,000. That means we have purchased the machine on 1st April 2010. Only one machine. We don't have the second machine. And that machine was continued from 1st April 2010 to 30th June 2013. On 30th June 2013, it was found that it is unsuitable and it was sold for rupees 4,000. Prepare the machine account from 2010 to 2013, assuming that accounts are closed on 31st December every year. So comparatively, it's a very simple problem because only one machine is there, and secondly, straight line method of depreciation is applied. The amount of depreciation will remain same. See here, machinery account, debit side, date particulars, JF amount, date particulars, JF amount, credit side. Debit side, 1st April 2010, the machine was purchased. To bank, cost. The cost of the machine is 18,000. And again to bank, installation charges paid 2,000. Now the total cost of the machine will be 20,000. Now depreciation will provide. By depreciation 10% of 20,000, but only for 9 months because the machine was purchased on 1st April and accounts are closed on 31st December. So 9 months depreciation. So 10% of 20,000 into 9 by 12, 1,500 rupees is the depreciation. Now take the total, 20,000. 20,000 minus 1,500, 18,500 is the closing value. First year completed. Now we are in the second year. 2011 January 1st. 2011 January 1st, to balance brought down 18,500. Now second year depreciation. By depreciation 10% of 20,000. We are following original cost method, straight line method. So every year depreciation will remain same. What is the original cost of the machine? 20,000. So 10% of 20,000, 2,000 rupees is the depreciation. So debit side 18,500. So 18,500 minus 2,000, 16,500 is the closing value at the end of second year. Now we have completed 2011. Now 2012. 2012 January 1st, to balance brought down 16,500. Now we close this 2012 also. So by depreciation, same depreciation, every year the amount of depreciation will remain same. How much depreciation? 2,000. Now subtract 16,500 minus 2,000, 14,500. This is the closing value at the end of the third year. Now we are in the 2013. In 2013, opening balance of the machine was 14,500. And during this 2013, the machine was sold. On which date it is sold? June 30th. June 30th means 6 months. After 6 months. We are starting the year from January 1st. From January 1st to June 30, 6 months. So after 6 months, the machine was sold. Already I told you, whenever a machine is sold, 3 entries we have to pass. The first entry is sale proceed. Second entry for depreciation for the period. Third entry for profit or loss. Now you see here. By on 2013 June 30th by bank sale. At what price it was sold given in the problem? 4,000 rupees it was sold. And depreciation will be provided for 6 months. For 1 year depreciation 2,000. So for 6 months it will be 1,000. So 1,000 depreciation. See here, beginning of the year the value of the machine was 14,500. And during the 6 month period the depreciation was 1,000. So 14,500 minus 1,000. 13,500 is the value of the machine and it was sold for 4,000. The value of the machine is 13,500, 14,500 beginning of the year, during 6 month period 1,000 depreciation. So 14,500 minus 1,000, 13,500 is the value of the machine, it is sold for 4,000. So loss, how much loss? 9,500. So by profit and loss account balancing figure 9,500. Or simply you take the debit side total 14,500, 14,500 minus 4,000 minus 1,000. The balancing figure is the loss on sale of machine, 9,500. That's it. So this is the end of second problem. Now we'll come to the problem number 3. See the third problem. If a firm purchased a machine on 1st January 2010, certain mill machinery for rupees 40,000. On 1st July 2010, additional machinery costing 20,000 was acquired. That means during the year 2010, 2 machines are purchased. The first machine is purchased on 1st January. The second machine is purchased on 1st July. And the first machine cost is 40,000. Second machine cost is 20,000. On 1st October 2012, the machinery acquired on 1st January 2010 was sold for 25,000. That means in the year, on the date of 1st October 2012, the first machine was sold. The first machine was purchased on 1st January 2010. That was sold away at rupees 25,000. And on the same date, a new machine was purchased for 38,000. Assuming 10% depreciation is charged under diminishing balance method, show the machinery account up to 31st December 2014. Up to 31st December 2014. So we have to follow diminishing balance method, 10% rate of depreciation according to diminishing balance method. So see here, machinery account. Debit side date particulars JF amount, credit side date particulars JF amount. First machine was purchased on 1st January 2010. So here I have written 2010 January 1st to bank cost 40,000. This is the first machine. And during the same year 2010, second machine was purchased on 1st July. So July 1st to bank cost 20,000. So 2 machines we have. The first machine 40,000, second machine 20,000. So total 60,000. Now we close the year. Every year the accounts are closed on 31st December. It is given in the problem. So 1st January to 31st December by depreciation. The first machine was used for the whole year because it was purchased on 1st Jan and a year ends on 31st December. So full year. So 40,000 into 10%, 4,000. The first machine depreciation 4,000. Second machine, 10% of 20,000, 2,000. Half of 2,000, 1,000. 1,000. Because it is purchased on 1st July, only 6 months the machine is used, half year. So for full year 2,000, for half year 1,000. So 4,000 plus 1,000, 5,000 is the depreciation first year. Now take the total, 60,000 minus 5,000, 55,000. 55,000 is the closing value of machinery, 2 machineries. Now brought down. 2011 January 1st. 2010 completed. 2011 January 1st to balance brought down 55,000. Now year end 31st December 2011. No transaction, no further purchase, no sale is there in the year 2011. We close the year. So 10% of 55,000. What is the written down value of both the machines? For both the machines, the WDV is 55,000. So 10% of 55,000, 5,500. Because we are following diminishing balance method. So 10% of 55,000, 5,500. 55,000 minus 5,500, 49,500. This is the closing value. 2011 completed. Now we are in 2012. 2012, to balance brought down. 49,500. Now October 2012, there is a sale. One machine was sold on 1st October 2012 for rupees 25,000. Which machine was sold? The machine which was purchased on 1st January 2010. 1st January 2010, first machine 40,000. This machine was sold. Whenever a machine is sold, 3 entries. The first entry will be sale proceed. So October 1st 2012, buy bank, sale 25,000. One entry over. Second entry, depreciation. Depreciation we have to find out in working notes. Then loss on sale 4,970. These two amounts we have to find out in working notes. Now come to working notes. Cost of the machine on 1st January 2010, 40,000. Now see here. The cost of the machine on 1st January 2010, 40,000. Less depreciation up to 31st December 2010. 1 year depreciation, 4,000. Deduct 4,000, 36,000. Less depreciation up to 31st December 2011. So 10% of 36,000, 3,600. Subtract 3,600. WDV on 1st January 2012. WDV on 1st January 2012, 32,400. And during 2012, 1st October, the machine is sold. So during the year 2012, how many months the machine is used? From January 1st to 1st October. 9 months. The machine is used for 9 months during 2012. Now we calculate depreciation for 9 months. So WDV on 1st January 2012, this one. Depreciation up to 1st October 2012. So 10% of 32,400 into 9 by 12, 2,430. So 2,430 is the depreciation for 9 months during the year 2012. So by depreciation 2,430. This is the depreciation. Now WDV on the date of sale. The WDV on the date of sale is 29,970 and the sale proceeds are 25,000. The machine is sold for 25,000. So 29,970 is the value of the machine and it is sold for 25,000. The loss on sale of machine is 4,970. Loss on sale of machine 4,970. Now take 4,970 loss. So these are the 3 entries we have to pass on the date of sale, 1st October. By bank, sale proceeds. By depreciation, 2,430 we got it. And by profit or loss, loss on sale, 4,970. Now we close the year 2012. 31st December 2012. By depreciation. Now still we have 2 more machines. The second machine which was purchased on July 1st, this machine is there. And a new machine is purchased on October 1st. October 1st, there is a sale of one machine and a new machine is also purchased. The cost of the new machine purchased is 38,000. Now we are having 2 machines. Second machine and third machine. The first machine is sold away. Now we have to provide depreciation on second machine and third machine. So by depreciation, here, 2012 December 31st, by depreciation. Machine number 2. Machine number 2, 1,710. How we got 1,710? In working note number 2 I have shown. Depreciation on machine 2. WDV on 1st January 2012. See here. WDV on 1st January 2012 is 49,500. This 49,500 is the WDV of 2 machines. First machine as well as second machine. Both the machines, the WDV is 49,500. From this we deduct the WDV of that machine which is sold. So WDV of the machine sold on 1st January, here it is. WDV on 1st January 2012, 32,400. So 32,400 is the WDV of the first machine. That will deduct. WDV of machine sold, 32,400. Deduct 17,100. So 17,100 is the WDV of the second machine. WDV of the second machine. So depreciation of 10% of 17,100, 1710. So take the depreciation on second machine, 1710. Third machine just now purchased, October 1st. So October, November, December, only 3 months of depreciation we have to provide. So 38,000 into 10%, 3,800. 3,800 into 3 by 12, 950 is the depreciation on the third machine. Now add up 1,710 plus 950, 2,660 is the total depreciation. Now we find out what is the closing balance of machinery account. So debit side you take the total 87,500. 87,500 minus 25,000 minus 2,430 minus 4,970 minus 2,660. That comes to 52,440. So 52,440 is the closing value of the machine on 31st December 2012. Now we are in 1st January 2013, 52,440. There are no purchase, no sale in the year 2013. We close the year 31st December 2013 by depreciation on this 52,440, 10%. We are following diminishing balance method. So 10% of 52,440, 5244. Now subtract 52,440 minus 5244. 47,196 is the closing value of machinery on 31st December 2013. Now we'll come to the last and final year, 2014. So to balance brought down 47,196. This is the opening balance. By depreciation, 10% of 47,196, 4720. 4720 is the depreciation. Now subtract 47,196 minus 4720, 42,476. So 42,476 is the closing value of machinery as on 31st December 2014. So it is asking you in the problem to calculate value as on 31st December 2014. We got it. 42,476. So we have completed 3 main problems on depreciation.